Hi everyone, so today's investor question topic is something we get asked a lot, and that's on the topic of dividend investing. What do we mean by this? Well, another way to rephrase the question is, do we only invest in businesses that pay out a high dividend as a way of generating additional investment income and returns? This is our investor question for the day. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG. Okay, let's jump right into this then. Let's begin by defining what is a dividend. Well, it's money that's paid out by a company to its shareholders, typically on a quarterly basis, based on the number of shares you own. Many investors crave dividends, when in reality, what they should be looking at is the underlying cash flow of the business, as dividends are only a derivative of cash flows. In other words, a high dividend yield isn't necessarily good if the cash flow backing it up is small or in decline. For example, there are a host of companies where investors bought the stock chasing high dividend yields, only to see the dividend cut later, causing these stocks to drop when many dividend-seeking investors sold off their shares to chase yield elsewhere. So in our opinion, chasing dividends can be very dangerous. We saw 56 companies out of the 500 S&P stocks, or 13% of the index, cut their dividends by June of 2020 because of the pandemic. And by the end of June 2020, a total of 639 companies across the stock market cut or suspended their dividends. These were not no-name companies either. Some notable examples were Boeing, Ford, and GM, who during the pandemic had to stop their dividend altogether. Other notable companies that lowered or suspended their dividend payouts were Royal Dutch Shell, who cut its dividend by 66%, the first reduction since 1945. Dunkin' Brands Group suspended its quarterly dividend of 40 cents and its share repurchase program. On April 28, 2020, Harley-Davidson halted share repurchases and cut its dividend to 2 cents a share from 38 cents. Columbia Sportswear temporarily suspended its quarterly dividend of 26 cents a share and also suspended its share repurchase program. As you can see, when a company announces a dividend or share repurchase program, there is no guarantee that the company will be able to pay out this cash indefinitely. Ironically, a low dividend or no dividend at all can potentially be better to optimize returns, because ideally, a business would actually be able to reinvest all of its cash flow into high returning projects and compound your investment faster. But what tends to happen is great businesses generate so much excess cash that they can't absorb and reinvest it all fast enough, so that they may end up paying a dividend. But again, the question isn't about dividends. It's about assessing the cash flow of the business. So let's look at this more closely. When a company has excess cash, what can they do with it? Well, they really have 5 options, and what we call this guard their cash flow. 1, growth. They can reinvest their cash flow in their own core business. 2, acquisitions. They can buy other synergistic businesses and hopefully not overpay. 3rd, they repurchase their stock at attractive prices and reduce their overall share count, which in turn gives existing shareholders the rights to more of the business's earnings. 4, dividends. They can pay out excess cash flow to shareholders and let the shareholders reinvest that cash flow how they please. And then 5, debt repayment, or they can build up their cash on their balance sheet. Ideally, a company would want to be able to invest in number 1 or 2, that is, either grow their existing business or find attractive acquisitions to hopefully compound your wealth at high rates of return. If they still have excess cash, then you move on to number 3 or number 4. And we should point out that both of these are essentially doing the same thing. Those are the 2 ways a company can distribute cash back to shareholders. But buying back stock is actually a much more tax-efficient way to return cash to shareholders, because you avoid taxation until you sell the stock. This actually brings up another point. If the reason an investor is seeking off the dividends is to provide cash flow for living expenses, they don't necessarily need to only identify high-paying dividend stocks. They can actually manufacture dividends on their own. As you can see by this chart, theoretically, if the cash a business earns is retained inside the company, then all things equal, the share price should go up by the amount of the cash retained. Whereas if the cash is paid out in a dividend, All things equal, the share price would decline by the amount of the dividend after it's distributed, like this. So if a company doesn't pay a dividend and the investor wants to access the cash being kept inside the business, all they need to do is sell off shares to essentially access that cash that was retained. What this shows is, ironically, shareholders would probably be better off if companies would buy back stock instead of paying a dividend, and then simply allow shareholders who needed the dividend to sell off appreciating shares whenever they needed the cash. This way, only the shareholders who needed the cash are taxed. In reality, by paying a dividend, you're forcing all shareholders to get taxed even if they didn't want the cash. This brings up another investor question we frequently get. Should I automatically reinvest dividends back into the stock? While we think it's very smart to reinvest dividends, I mean, come on, why did you invest in the first place? Was it only to have them give you back the money right away? Or was it to invest? So yes, it's smart to reinvest dividends, but we don't recommend doing an automatic dividend reinvestment plan in individual stocks because this removes your freedom. We think it's better for you to take the cash and reinvest wherever you think is the best reinvestment opportunity at the time, as opposed to automatically being forced to reinvest in the same company. We should point out, though, that we view this very differently for a mutual fund. In most circumstances, we recommend that an investor reinvest their mutual fund shares so that the mutual fund manager can keep reinvesting that cash for you across a diversified portfolio of holdings. So coming back to a company's dividend policy, another dilemma with a dividend policy is that they tend to limit a company's flexibility. Since investors tend to get addicted to dividends, if you start paying regular dividends, it's very hard to stop. Therefore, in a world with so much disruption and innovation, dividends can actually impede resilience and adaptability. Companies like AT&T and ExxonMobil and a number of the consumer staples should have reduced their dividends long ago, but instead they underinvested in innovation and or levered up their balance sheet to make them be able to afford paying their dividends, only increasing their fragility. Some companies were simply borrowing money to pay dividends, digging a deeper hole over time. This is clearly an instance where a high dividend yield isn't helpful at all. When this happens, it threatens the long-term survival of the firm and generally doesn't prevent the dividend cut, but rather only forestalls it, as the recent case of AT&T shows. So rather than focus on dividends, we think it's far more important to focus on the underlying cash flow of the business. And we believe the best way to see that cash flow remain resilient and grow over time is by owning businesses that are capital light, with global network effects that give them pricing power, enabling them to generate strong cash flows that can either be reinvested at high rates within the company or have excess cash that is truly free to support distributions to shareholders, whether that be via dividends or share repurchase programs. Thanks for the great question today. Check out our other videos and we'll see you next time. Thanks for watching.